The price that I've picked is $422.22. That's 100 times the current price. So what would happen here is that if you revalue it to 4,222.22, the gold certificates will be worth just over $1.1 trillion.
Today, this morning, it shot up again, another $44 up this morning, and we are at whopping great $3,806. 3805, 3806 today. When gold moves, we also see all the precious metals complex moving. So looking at silver, that is priced at $46.68 at the moment. $47. Yeah, you can see it when it did this morning briefly move over $47. It's coming off very sharply now. It's $46.67.
The gold market has entered uncharted territory, with prices surging to historic highs, signaling a broader challenge to the dollar's dominance. Gold recently pushed past $3,800 an ounce, while silver briefly climbed above $47, reinforcing the strength of the entire precious metals complex. At the same time, geopolitical dynamics are shifting as China and the BRICS nations continue building independent gold markets, steadily undermining the grip of New York and London. Against this backdrop, discussions are turning to whether the United States should consider revaluing its own gold reserves. This action could alter the global financial balance and help stabilize domestic debt markets. MarioInnecco, a veteran voice in the sound money community, and Clive Thompson, a seasoned financial analyst, shed light on why a symbolic revaluation, such as moving the statutory gold price from $42.22 to $4,222, could provide the Treasury with over $1 trillion in accounting gains. This maneuver would not only demonstrate to the world that the U.S. still has strategic tools at its disposal, but could also be used to ease pressure on long-term bond yields, reduce mortgage costs, and even fund critical infrastructure. While such a move won't fix decades of economic imbalances overnight, it could serve as a powerful signal that America intends to defend its financial standing in a rapidly evolving multipolar world. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
Today, we're going to look at something slightly different, but it's still a challenge to dollar hegemony, to the hegemony of the New York-London axis. And that's China again. They're challenging the gold market in London and New York. And yeah, that's not just a challenge from China. Of course, it's BRICS as well. China is leading BRICS. And the reason we cover this so much is not because we love BRICS and we love China. It's just that we want to warn people of what's going on and how it will affect their financial health. And it's already affecting because the dollar and all other fiat currencies are losing value hand over fist versus gold and silver, which is very inflationary. And have you noticed how your standard of living has dropped so much in the last few years? So, but I'm going to do something different today. I'm going to give a suggestion to the United States or to America, what it could do to fight back a bit against these forces from China and BRICS. So yeah, gold has been doing very well. Of course, in 2025, we traded up from 2,600 at the beginning of the year to 3,500 by around mid-April. Then we had a consolidation for 4 months. And then we broke out of that consolidation like a symmetrical triangle, which is very bullish. And I think one of the triggers was Chairman Jay Powell, Chairman of the Fed, Jay Powell's speech at Jackson Hole. He nodded that they would start cutting rates again, and surely they did in September by 25 basis points. At the same time, we're seeing Russia, China, and other BRICS countries continue to buy gold and silver. Russia and China are also building independent gold markets in moves to bypass the US dollar. and it's something that we just spoke about, right? So these changes have helped actually push gold to historic levels, breaking its 1980 inflation-adjusted high. And Goldman Sachs even named gold its highest conviction trade ever. And they're calling even for $5,000 gold by next year. As there's been a lot of people that some of them I've interviewed calling for $20,000 price, $40,000 even. So the last time the United States Treasury or the United States revalued the gold price, the statutory gold price, was back in 1973 from $38 to $42.22. And in 1972, they had revalued as well from 35 to 38. And so it's been at $42.22 ever since. And the gold is supposedly in Fort Knox and also in other depositories like I think Denver Airport and West Point. And there hasn't been an audit, even though the Secretary of the Treasury has said that they audit it every year. But I suspect that all the gold that has flowed into the U.S. since the end of last year, when we've spoken about this quite a lot of it could be the U.S. Treasury buying or taking the gold back. And what does that mean? Well, the speculation from the analysts, and especially people in the gold bug sound money world, is that the Treasury has been leasing out that gold many times over in order to keep the price of gold under control. But now that they're thinking about revaluing, they need to show the gold. So, or they might not, the markets might take their word for it that the gold's there. But if they're like covering their leases of gold, that means it drives the price up because you have to buy back your shorts. And it could be one of the reasons why we are at all-time highs, and we could go even further up. So, and the price that I'm thinking of for the symbolic revaluation, and I'll tell you why I think, why I've come up with this term symbolic in a minute, but the price that I've picked is $422.22. That's 100 times the current price. So right now, that gold is valued on the Fed's balance sheet because the Fed holds gold certificates that the Treasury sent to them when the Fed sent the Treasury all the gold that FDR confiscated back in 1933 to the Treasury, right? So that gold, the gold certificates are valued just over $11 billion. So what would happen here is that if you revalue it to 4,222.22, the gold certificates will be worth just over $1.1 trillion. And then if you subtract the 11 billion from that 1.1 trillion, you arrive at 1.09 trillion. So that's the profit that the Treasury will make from that accounting. Well, it's an accounting process, right? I think it's because a lot of people were expecting 10, 15, 20, 30, or 40 revaluation. That I think would play right into China's and BRICS, the BRICS hands, because I think China and Russia have a lot of gold. I spoke about how China has over 30,000. Yeah, that's speculation, but there's been really good research about that. Yeah, and that would really hammer the dollar because a much higher gold price means a lot weaker dollar. So 4,222 is not really a massive devaluation of the dollar or a massive revaluation of gold, but what it would do with this extra trillion plus for the Treasury is that it would help them maybe, and nothing's certain here, it would help them maybe stabilize the longer end of the U.S. Treasury market. And why is that important? Well, because the U.S. Treasury is paying more on interest payments now than the military budget. And if the long-term yields keep rising, that's going to get worse. So what the Treasury could do here with that 1 trillion, they could take, let's say, 500 billion or 700 billion and buy back or retire a lot of the long-term debt that the Fed has on its balance sheet from the QE programs. That would make a lot of sense. That would drive down longer-term yields. It would help bring down mortgage rates or mortgage yields, which would help the housing market. And it would flatten the yield curve. What they could do with the rest, depending on the proportion they do, they could use that to start their sovereign wealth fund, which they've spoken about. And I know that I'm a proponent of free markets and small government, but right now, I guess this is a fight for survival, and the U.S. needs to do whatever it takes to try to combat China and the new multipolar world. I think the people that have been in charge of the United States prior to now, the non-Trump presidents and Congresses, they've neglected a lot the real economy. And I think, with that sovereign wealth fund, they could buy or help develop infrastructure for mining, for industry. And the other reason I think it's symbolic is because it would show the world that the United States has this weapon of gold revaluation, and that it's not gonna just cave in to BRICS and China. It's a long shot, of course, and I think there's a lot more that needs to be done because the erosion and the hollowing out of the U.S. economy has happened over decades, and something like this is not going to solve the problems overnight, but I think it's a good step forward as well.
Precious metals have entered a powerful rally, with gold leading the charge. In just 1 week, prices jumped from around $3,500 to above $3,800, marking one of the strongest upward surges in years. The move has been fueled by massive inflows into gold-backed ETFs, totaling over $5.6 billion in a single week. This type of capital movement indicates that investors, both retail and institutional, are reallocating their investments into gold as confidence in fiat currencies wanes. Alongside gold, silver has climbed sharply, breaking above $47 before settling near $46.70, a remarkable rise from its previous level of just $39 a month ago. This surge has also sparked growth in the mining sector. Gold miners, which have historically lagged behind the metal, are now outpacing it. The GDX index has soared from around $35 earlier in the year to over $70, reflecting both higher profitability and expectations of sustained elevated prices. At the institutional level, strategies are also shifting. Morgan Stanley recently restructured its classic 60-40 portfolio model into a 60-20-20 split, with gold now given a full 20% allocation. That decision highlights a recognition that inflationary pressures will erode the value of bonds, while gold remains a proven hedge against inflation. Let's get back to the interview.
One of the big stories last week was the huge surge in the price of precious metals. So gold literally surged last week. Let's have a look at that on the browser. Here we are. So you see the gold price literally shooting upwards. Let's make it a 1 month move here. Just have a look at the distance. So you see last week, we probably started the week, ended last week on the Friday at around 3,500. By midweek, we were at 3,600. And then at the end of the week, we were at 3,700. Today, this morning, it shot up again, another $44 up this morning. And we are at a whopping great $3,806. And gold is not alone. Other precious metals are following in its suit, or maybe they're leading sometimes. Now, just on gold, we've heard that there's been very strong inflows into the exchange-traded funds, the physically backed gold ETFs. Last week, the number of assets going in was an inflow of $5.6 billion US dollars. So what does that indicate? It indicates that maybe retail investors are starting to wake up a little bit, or maybe it's institutional investors, but someone out there is starting to add gold to their portfolios a little bit. And when the gold market, so what we're also seeing going with the gold market is the miners. The gold mining stocks are rising very rapidly too. Now, for most of the last few years, gold was rising, but the gold miners were really lagging. They weren't moving as much as gold. But this year, gold miners are moving faster than gold upwards, which is to be expected. So it's quite normal that there's a lag of maybe a couple of years, because between the time the gold price rises and the time that a gold miner can turn that into profits, it's going to be a lag of more than a year. It's going to be a year and a half or 2 years. So now those profits, as companies report their profits, they're reporting much higher profits than a year ago, and that is boosting their share prices. But next year, we're going to have even more of these boosts in profits, because the gold price is much higher than the average gold price at which they were selling their gold over the last 12 months. So they're reporting profits now, they're reporting the average gold price of the last 3 months or 6 months or 12 months, which was lower than today's price, which means that if today's price holds up, which I think it probably will, it means that the profits next year or next quarter, next half year, next year, and so on will be higher than they are today. So that's what's driving gold miners. And if we look at the GDX, which tracks the gold miners index, you can see it's been going up to the end of August, and the price was around $63, give or take. It's now $74. So what does that tell us? It tells us that not only the gold miners ETF is rising, but the underlying stocks, the underlying gold miners, rising in price. So that's reflecting the fact that people expect them to sell their gold at a much higher price next year than they've been selling it at recently. And if we go back and look at the year-to-date on the GDX, you can see it's had an absolutely massive rise so far this year, literally doubling from about 35 to over 70. Well, now $74, but over $70. What else is moving? Well, when gold moves, we also see all the precious metals complex moving. So looking at silver, that is priced at $46.68 at the moment. And I think at one point, it even this morning touched $37. Let's just have a quick look, see if we can see that. I'll look at the very short-term 5-day move, and $47. Yeah, you can see it when it did this morning, briefly move over $47. It's coming off very sharply now. It's $46.67. But if you think about it, in a month, let's go back a month ago and see how far it's gone. It's gone a huge distance in a month. Here we are at the beginning of September. Beginning of September, it was at $39. And now it's $46. So that's $7 in a month. An incredible move. So let's see what's going on. I think we're starting to see more and more institutions notice that gold is one of the best performing assets this year, if not the best performing assets. And we saw that Morgan Stanley last week put out a note saying it's shifting its 60-40 model. The 60-40 model says you're going to have 60% equities and 40% bonds. They've shifted that to 60-20-20. So it's now 60 equities, 20 bonds, and guess what? 20 in gold. Now, wouldn't it be amazing if every institution in the world suddenly decided they wanted 20% in gold? That would be impossible. It's impossible for every investor to hold that much gold. But one institution can do it, and maybe one or two others might decide to do it. But I think what even if we get a very tiny move from the current 0.5% exposure to gold to, let's say, 2%, doesn't sound much. That would be 4 times as much gold held in portfolios, and it would be really transformative for the gold price if that were to happen. Now, why are Morgan Stanley making this move of 20% from bonds into gold? Well, simply speaking, we've got inflation coming, or that's what people think. And if you need protection, here's the message: bonds are going to be the biggest victims of inflation, and gold is the hedge against inflation. So that kind of explains why money is moving into gold at the moment. 10-year Treasury yields currently 4.2%, nothing special to say there, but we've got the ongoing rise in US government debt. That's putting pressure on the US dollar. The DXY hasn't changed much, it's at about 97.5. But let's look at sterling, which continues to slide. So let's go to currencies, I'll bring that up. So we'll start, actually I've got the DXY as the first one there. So that's your DXY. You can see it sliding in the last few days a little bit, not much. Come down from 98.5 to 97.90. Obviously, since the start of the year, it's been sliding. So I go to the year to date here, and you can see it slid from 108, 110 down to 97, about 10 or 11% off. Looking at the currencies, there's no big news except for the euro versus sterling. Sterling continues to fall compared with the euro. And there you see it on the chart, sort of straight down. Now, what about the US government shutdown risk? You've probably heard about it and don't know much about it. So I'm going to explain what's going on there. The US financial year runs until 30th of September each year. So that's coming up in a few days. Under the law, money cannot be spent without the approval of Congress. So the Constitution requires approval for all spending. So once we get past the 30th of September, unless they passed a variety of new bills, an extension to allow payments to continue, many government departments will have to shut down. They'll have to furlough staff. Only certain essentials will continue, like defense, law enforcement, social security. There's no automatic rollover where they can keep spending the money. So what does this mean? It means many government departments might close. Markets aren't going to like that. They don't like near-term volatility. They don't like a closed-down market. So if we get that, we might see further pressure from the credit rating agencies who might reduce the rating of the USA once again. Another bit of news from last week. China had a massive surplus in August. It was 102.3 billion trade surplus, up from 98 billion in July. So whilst exports are softening a little bit, there does seem to be ongoing trade, but the markets, we'll see how this trade goes next month. So let's go back to the biggest move this day. We showed it earlier today, but I know you all want to know what the latest gold price is, and it is moving up. Economic data, let's go to gold. Yeah, so now it's moved up a bit more. It's now at $52.62 at $3,814. Meanwhile, silver's moved up again in the morning since I started speaking. It's up 86 cents now at $46.92, virtually at that $47 level, and clearly looks like it wants to go beyond the all-time high of $50 in the coming days. Platinum is 1605, above the 1,600 level. It's moved a lot in the last few days. You can see it's been rocketing up this morning. And palladium is 1,292.
Capital is beginning to recognize the limitations of traditional assets and is seeking stores of value that can withstand cycles of inflation, currency weakness, and market instability. Precious metals, whether gold as the anchor, silver as the high beta companion, or diversified baskets that include platinum and palladium, are once again proving their relevance. The speed of recent moves suggests that money on the sidelines is no longer waiting but actively reallocating into hard assets. For long-term investors, this is not about chasing short-term spikes, but about positioning for what could be a sustained repricing of monetary metals. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.